Hey, Accounting 604, this is our seventh and last video in Module 6. And we consider now, perhaps for the first time in any real consideration, intangible assets. And so as you can see from the title slide, we begin to dive into our accounting and analysis consideration of intangible assets. What are we talking about? What is an intangible asset? Well, typically we are talking about, in this class, one primary class of intangible assets, and that is goodwill. And so what is, technically speaking, goodwill? Goodwill occurs when one company acquires another. It may, in a very, very rare case, simply be a purchase price determined by the sum of the asset value of all of the assets that the acquired firm possesses. You simply add up, what do you got, and we will pay you exactly what the accounting value for all your assets is, and then we will change hands and we'll have new owners. However, that is really, except in the technical sense, the theoretical sense, never what actually happens. Typically, a company pays far more than simply the asset value, many times far more than the market value of stock of that company. And when that happens, there is an intangible asset called goodwill created. And this deck really does start to look at what is going on in the assessment of goodwill. Now, goodwill is not the only kind of intangible asset. It may be looked at as the sum of intangible assets. What are intangible assets? Assets that quite simply cannot easily be reliably measured. It doesn't mean that they're not real. It doesn't mean, at least in the technical sense, that there's no way to actually touch them. It simply means, from an accounting perspective, you cannot reasonably estimate the value or cost, historical cost, of this particular type of asset, which may have incredible, tremendous value that is simply difficult at a point in time to measure. The sum of these things make up a difference between book value and real market value. And you can see that sort of illustrated in this graph below, that over time, this wide disparity between what the book value of stockholders' equity and what the market deems a company is really worth. You see that, of course, now more than ever with tech companies in the stock market, right? Valuations in terms of market capitalization of stock that far exponentially exceed actual earnings or net cash flows, right? And so many times this is due not only to future expectations, but to the value accrued or assessed by the market in general to this accumulation of intangible assets. What are some of these possible assets, you might ask? Well, we have a slide for that. Here is a non-comprehensive list of examples that might be in consideration. Some easy to understand, like trademarks, trade names, the value of a trade name or a service mark. It could be the value of a newspaper masthead. Moving down the next set, it could be the customer intangible assets, the list or book of customers that are loyal to that acquired company, right? The relationships and the network that goes into that. It could be, especially with creative works, right? Artistic related intangible assets. You see sort of the list there, right? If you are acquiring, for instance, the book of publishing from, for instance, the Pop Act Hall & Oates, all of the compositions written together, or at least attributed together to Daryl Hall and John Oates, well, that was the subject of an impending lawsuit that was finally settled between those two guys, who will probably never work together again, but nevertheless, there's an enormous amount of value in their catalog. You can see technology-based intangible assets, skipping over to the second column there, patented technology, or even unpatented technology, right? Trade secrets, secret formulas, or all of these, the second bullet point, all of these different types of contract based intangible assets. And so for all of these kinds of reasons, typically when a company acquires another company, the acquisition price is far more than simply the sum total, the number that's equal to the book value of the net assets owned by the acquired company. Here's an example of this. This is a relatively recent acquisition in 2022 that was finalized on Valentine's Day. I don't know if there's any real significance to that. On February 14th, 2022, AMD acquired Xilinx. And you can see there, if you follow that rather long table there, you'll see that the fair value of net assets acquired, all of this in millions of dollars, of course, was 26,009, but they paid 48. Wait a minute. The fair value of the assets of Xilinx was 26, but you paid $48 billion for this company. You can see the calculation. Goodwill is simply the difference between the price paid and the economic or accounting value of the net assets, which adds up to about $23 billion worth of goodwill. That is, in one sense, what we might call, from an accounting perspective, the overpayment. But from, of course, AMD's perspective, this is the price of acquiring this company. You had to pay $48.8 billion to acquire this company. Surely there has to be more involved with Xilinx to warrant a $48 billion purchase price other than the net value, the fair value, the accounting value of their net assets. Indeed, what was going on here? Why would a company spend $48.8 billion to acquire this company? Well, if you set the Wayback Machine for the early 2020s, you may remember in the chipmaker space there was a wave of acquisitions, and at least in one case a failed acquisition. Right? It didn't go through, but nevertheless the big players were trying to grow into other spaces through acquiring smaller companies. AMD, which has historically been very big in the CPU and GPU space, acquired Xilinx because of Xilinx's footprint in FPGA and SoC. If you're familiar with those acronyms in the tech industry, you realize that's an entirely different playing space. For those of you who are perhaps are not familiar with field programmable chip spaces or system on chip, right? It basically meant AMD could now reach into industries that it previously didn't really have much product footprint, and those would be telecom, aerospace, and aerospace by extension defense, as well as the automotive space. And so now by acquiring Xilinx, they had product that had already won a footprint in those other industries. Another part of this acquisition, as you can see here, looking at the declared and identified intangible assets. You see them there. Okay, what's the fair value of the developed technology that Xilinx already had? What was the value of the customer relationships, the customer backlog, the corporate trade name, the product trademarks? You can see not only a fair value of millions of dollars assigned and estimated, but also the estimated useful life of each of those, right? And so in attempts to really estimate the actual value of the identified intangibles that were acquired in the purchase. There are several valuation models for intangible assets. You see some of them there. The relief from royalty method, which essentially conceptually says, okay, by acquiring this company and acquiring this asset means you don't have to go and purchase the usefulness and pay a royalty for it, because now you're just buying it outright. So what's the net present value of those royalty payments you would have paid, and therefore relief from that theoretical royalty payment is the present value of buying the technology instead, right? You can see some of the other models and methods that are used there as well. And all of these methods, including, as you see here, the real option pricing, replacement cost method, less obsolescence, right? Essentially what those are is management's call how to reasonably lay a value to the particular intangible asset, and what would you have to do instead in order to acquire that kind of capability. Now, some notes about accounting for goodwill. As you can see here, goodwill is not amortized for the simple reason that it is considered to have an indefinite or infinite lifespan, simply cannot be measured, and therefore we don't apply amortization, which of course is the intangible version of depreciation. However, it does have to be evaluated for impairment on an annual basis, and there are strict rules about evaluating at the same time each year. What is the impairment test for goodwill? You see the bullet points there below. First, you have to estimate the fair value of each subsidiary that has goodwill on its balance sheet. And then you have to compare the estimated fair value of the subsidiary to its carrying value on the balance sheet. And if the fair value has dropped below the carrying value, then the subsidiary fails the impairment test, and you have to write down the value. All right, we hope that this brief look at goodwill and dealing with the impairment thereof provides at least a brief look at how to deal with, well, for instance, larger companies that have acquired subsidiaries and therefore list goodwill as a fairly large intangible asset on their balance sheet. This concludes then our look at these long-lived assets, PP&E and intangibles and those kinds of things, in our 7th video. We hope this is helpful. You'll deal with each of these concepts to some degree with the homework as well as the ongoing group project. We'll see you in the next module.